banks began to lend loans to non-eligible people in the market. So this is basically being supplied. So when US started to give loans to non-eligible people, it began to fall the economy. It affected the whole economy in the world because bank is connected to everywhere. So too many risky loans, first of all, US banks given to people. So when too much risky loans are given to the non-eligible people, they started not repaying the loan. So the first case, and this bubble started to rise. In 2002 to 2006, the housing rate started increasing at that point. So people thought that this will increase in further future. So people started to buy more house. So this way the bubble started to rise. And next is a bank packed with risky loans and sold to investors. These loans were sold to the investors and investors started to buy this. And banks created more money in those areas. So this all created more damage to the economy. And last is when these loans are given to the non-eligible people, they start not repaying them. So this was the bubble blast, and this affected the economy huge. In simple words, bank gave loans to the wrong people, house prices crashed, bank collapsed, the world economy fell. This is the actual crisis in 2007 to 2008. What happened in a short note summary.
Today I'm highlighting the global impact of two major economic crises, the 2008 subprime crisis and the COVID-19 downturn. The 2008 crisis started in the US housing market but quickly spread worldwide. It erased around $20 trillion in US household wealth, pushed unemployment to nearly 10% and turned global GDP growth from 4% to 1.5%. Countries like Mexico and Spain faced deep recession and global tourism dropped sharply. It exposed major flaws in the financial system. COVID-19, unlike 2008, was a health-driven crisis. Lockdowns, supply chain shutdowns, and millions of deaths caused global GDP losses up to $9 trillion in 2020 alone. The US and China faced heavy economic hits, and sectors like tourism, aviation, and retail saw historic declines. Both crises reshaped the global economy, one through financial collapse, the other through health shock, showing how interconnected and vulnerable our world truly is.
Impact on Indian economy. During the global financial crisis of 2008, India, which has been growing rapidly at around 9% in 2007 to 2008, saw its GDP growth fall down to below 7% of the following year. The biggest reason was the decline in global demand, which sharply reduces India exports. Foreign institution investors pulled out larger amounts of capital, creating volatility in the stocks markets and weakening business confidence. However, unlike Western economies, India's bank had very limited exposure to toxic mortgage-backed securities that caused the crisis. This helped the country avoid major bank failures. Even then, India faced a slowdown in investment activity, falling in industrial productions, and tighter credit availability, which together reduces Indian economic moment. Next, we are going to see about how the situation during the COVID-19 pandemic. India experienced one of the most severe national lockdowns globally. The economic contracted by minus 7.3% in 2020 to 2021. The worst performance in India's history. Sectors that rely heavily on physical interactions such as tourism, hospitality, retail, construction, and transportation were hit in the hardest. Supply chains were disrupted, affecting both manufacturing and agriculture. Consumer spending collapsed as millions lost jobs, especially in the informal sector, which employs more than 80% of workforce. The combined effect was a disappeared economic shock that required stock government intervention, relief package, and vaccination efforts to support recovery.
Today I am going to talk about measures taken by India to counter the crisis. One is GFC policy response and other one is COVID-19 policy response. The Reserve Bank of India employed counters monetary policies to reduce the cash reserve ratio, and liquidity was enhanced through open market operations. Fiscal stimulus packages includes excise duties and increased infrastructure spending and target supported to export dependent sectors. And the other one is like COVID-19 policy responses. India launched comprehensive packages under the Airpen's Bharat initiative, including director cash transfer, food security measures for millions under public distribution systems, and a credit guarantee scheme for micro, small, medium enterprises (RBB), and introduced monetary loans, repayments, liquids windows, and bank NBF emergency credits. This phased vaccination programs and reopening strategy aided
Good
recovery.
morning, friends. So I will be doing the industry impact of both of these crises. And as we all know by now, both these crises happened at different time periods and caused due to different events. So this impacts were on different sectors. There were financial services, real estate, construction, and various other manufacturing sectors, and also various other industries as well. The financial sector actually was the epicenter of the crisis. Major banks and financial institutions faced insolvency. As we all know, insolvency is a state where you can't pay the debts. The result was a freeze in the international lending and a significant loss of investor confidence. The housing sector collapsed, leading to a sharp decline in home value and significant slowdown in new construction. The decline in consumer demand and global trade resulted in severe impact on the manufacturing sector. The major sector that was affected was travel and hospitality sector. It was the hardest hit due to travel bans, as we all know, social distancing measures and lockdowns. Now, when it comes to technology and e-commerce, comparatively, they had a higher demand due to the shift to remote work. Now, while talking about financial markets, even though stock markets initially went down, but decisive and quick actions by the central bank led to speedy recovery in the financial market sector. Now, these are the major industrial impacts that happened due to the two crises, the subprime crisis and the economic downturn due to the COVID pandemic.
Hi all, I'm Mirar Menon and I'll be concluding the topic analysis of two global economic crises. The global financial crisis and the COVID-19 downturn were two very different types of crises, caused and transmitted through the entirely distinct channels. While this GFC originated weakness within the financial system and spread through the global economic linkages, the COVID-19 crisis resulted from the unexpected health emergency disrupting both supply and demand at the same time. India's response to both situations shows the value of strong financial oversight, flexible fiscal policies, and effective social welfare systems. Overall, this comparison highlights the importance of building the resilient economy that can withstand disruption in both financial markets and real economic activities. It also emphasizes the need for well-designed policies to support vulnerable sectors such as tourism and hospitality, which are more exposed during these crises. Thank you.